Good morning, good afternoon, good evening, wherever you are in the world, and welcome to this special session of navigating crypto markets with trusted data, or needing trusted data, I should say. But we're going to get into it. My name is Alex Wenham. I'm the digital asset product and strategy lead at Bloomberg, and I'm joined by Ambre Soubiran, for the CEO of Kaiko, one of the OGs in the crypto market data space. Maybe just to get us started, could you maybe just give us a brief introduction to yourself and also to Kaiko?
Yes, absolutely. Thanks, Alex. So my name is Ambre Soubiran. I'm the CEO of Kaiko. And Kaiko is the oldest market data provider dedicated to the cryptocurrency industry. We've been around for 10 years this year. And we are a team of about 100 people, geographically dispersed across New York, London, Paris, Singapore, and Hong Kong. And we focus on the institutional segment of cryptocurrency players, meaning regulated entities, regulators themselves, research companies, banks, custodians, market infrastructure providers, anybody who basically needs to interact with market data that is regulated, audited, and provided in real time.
Awesome. So founded in 2014.
Yes.
I can't imagine the sources of pricing and market data in 2014. I mean, obviously, the pace of innovation in this market is huge, and I would say that coming from a traditional finance world, the kind of value of data is very much well known. But I would say in the crypto world, this kind of value of data is something that Kaiko has created a kind of initial niche, and one that's become a very important part of the crypto ecosystem. But the way that we look at these things in Bloomberg, when we look to cover crypto ourselves, is that there's thousands of assets, there's hundreds of exchanges. A simple thing like the price of Bitcoin, which you would expect if you're looking at an equity, is not an easy question to necessarily answer in crypto. So maybe kind of looking over the crypto landscape and the kind of market data challenges there, maybe give us I don't know, like I'd be interested from the 2014 angle, but how things have progressed of what you kind of think are the challenges, but also how you kind of get high quality market data from this fragmented market.
Absolutely. And so, I mean, just maybe taking a step back to your point, the market has completely transformed over the past 10 years. When Kaiko started, DEXs were not a thing. You did not have DeFi. It was really the early days of Ethereum. And so market data is basically data taken from wherever there is a market activity. And as far as cryptocurrencies were concerned, market activity was only created on centralized cryptocurrency exchanges back then. So those exchanges were exposing real-time order book data as well as executed transaction data on APIs. So we started off back in 2014 as being a data aggregator more than anything. It was more of an infrastructure technical challenge, as you mentioned, of connecting to, today it's hundreds, but back then there was probably a couple dozen cryptocurrency exchanges. And there was this challenge on making sure that we connected to all of these APIs and we were able to gather in real time all of the market data related to all of the assets that were trading on those exchanges. That was the first challenge for Kaiko, was being a trusted source of market data. Then, as the time evolved, we've started seeing the existence of decentralized financial application, DeFi, DEXs, lending and borrowing protocols. And this created a new set of challenges for a data provider such as ourselves, which was, how do you run a blockchain infrastructure in order to see the data in real time? You needed to become a validator, to become a node operator, and to kind of see market data as it was being created directly within blocks on chain. And not just being able, from a technical standpoint, to run that architecture, but also being able to contextualize data and give it meaning, right? When you see, okay, this was a buy order on a centralized exchange, the format is relatively straightforward. Understanding DeFi data from a block is very different in nature. What you have is a list of events that are organized, but that are not necessarily contextualized. And so that created a new part of what we do at Kaiko Data, which is our DeFi market data offering, which involves the technical part of running blockchain nodes, but also the technical part of giving meaning to the data within blocks. And so that's the centralized exchange market data, and the DeFi market data is what encompasses today what we call market data. And then we have a second section of Kaiko, which also is kind of new to the past, I would say 3-4 years, is what we call derived data. Derived data feeds off of market data and creates higher value added products such as analytics, risk management metrics, implied volatility surfaces, all of those more quantitative analytics type of data sets that are used by traders, people that are actively investing in the markets and need to monitor their position, understand the market dynamics. So this is analytics. And finally, just to kind of close on those 10 years of evolution of market data, is indices, right? So our last product family within the derived data section is everything we do around rates and benchmarks and indices. And this is obviously extremely topical, especially this year in the context of ETFs and kind of passive investment financial products, for which you actually, from a regulatory standpoint, need regulated market data. And that's, I would say, the most advanced part of the derived data sets. So it's a bit of a, 10 years in review of market data.
No, great. I think, since we talk about the kind of 10 years in review of market data, I think what's also interesting to contextualize over that period is probably the change in your clientele. Who were the customers that you started serving? And as the markets progressed, you said like adding in decentralized exchanges as a new technology in 2020-ish. How have the customers that you serve changed over that period as well?
Yeah, absolutely. So when we started 10 years ago, there was, to be very blunt, there was absolutely no institutional market, right? 2014 was a very, very retail-driven crypto industry with a lot of people that were taking kind of directional bets on, I'm going to buy Bitcoin because I believe in Bitcoin. It was almost a religious thing more than a, wise investment decision at the time. So our first clients were people that were trying to start arbitraging and benefiting from market inefficiencies across exchanges, across centralized exchanges, right? So there were a couple of funds that had been started to do those kind of arbitrage strategies. That's how it started. Then we had ICO summer, where people were trying to value tokens. So they were like, okay, there's this token that's going to soon be listed on an exchange. And so how do I model the fair price of a given token? And all of these things needed to run backtesting, simulations, taking proxies to see how such asset would evolve compared to another asset that had been listed 6 months ago or a year ago. And those were the first, I would say semi-pro use cases for market data. For any retail person, you had a bunch of free market data sources available. I personally used, CoinMarketCap back then when I wanted to check something. But for any use case that was starting to get a little bit more professional, you needed to have a more, sophisticated feed of information. And so those were the first use case really for people that were willing to spend money on market data. And then obviously we started to see two things: research companies, academia. We worked a lot back in the days on supporting students that were doing research on cryptocurrencies and that needed to understand the market microstructures. Then we started working with early on central banks and regulators that were trying to understand the space. So it was a lot of research and market supervision. And then we had the emergence of what we call today mid-markets, right? So crypto corporates that were scaling and that needed to rely on sophisticated market data, but it was not yet TradFi institutions looking at crypto. I would say that this market, this TradFi institutional market came to life, I would say 2021-ish. And that is really when we saw all of the major financial institutions publicly announced that they were launching digital asset focused groups and that there was a bunch of initiatives working on two things. One of them was let's look at crypto as a new investable asset class. And I would love to hear your thoughts on. I think it coincides with the moment Bloomberg decided to onboard cryptocurrency as an asset class, which is driven by client demand, et cetera, as far as I understand. And then there's the other side of the spectrum, which is financial institutions looking at asset tokenization and blockchain, not from a investable asset class standpoint, but rather from a technology and infrastructure standpoint. And I believe that those two things happened in parallel in 2020, 2021.
Well, I'm glad you mentioned Bloomberg. We're definitely a happy customer of Kaiko's. You definitely enable us to navigate parts of the crypto market that that are difficult for us to do in scale, and enable us to kind of solve for our traditional clients' needs in cryptocurrency. And look, when we think about those traditional customers, at least from a Bloomberg perspective, right? Again, there's thousands of assets. They trade on hundreds of exchanges. So, getting a kind of cohort of assets that are institutionally robust is kind of step one. Maybe if we kind of pivot a little bit, and of course, you can't not talk about institutional adoption and the Bitcoin ETFs in the US, and of course the 13F filings, which are showing, kind of asset managers with more than 100 million, where they're kind of like making allocations in the space, and the sheer number of allocators, right? I think around 1,000 into those new ETFs is quite phenomenal. And I think since January, like net 12 billion new capital has flowed in. But this is just like a long asset only, one asset kind of strategy, right? It's like the simplest of the kind of index products that could be out there. As you mentioned about your kind of business and how it's evolving, the index part of that is a huge growth potential. So, where do you see the kind of evolution of traditional financial investment, either ETFs or other kind of strategies starting to come in play, particularly through the lens of your kind of index business and how you're kind of gearing up to serve that?
So we're seeing two things. On the, I would say, more vanilla side of things, you mentioned the impressive growth and traction of the Bitcoin ETF since the beginning of the year. There's been some noise and activity, some exciting, I would say, buzz around the prospect of having an Ethereum ETF approved this summer-ish or during fall. And I think this is, very interesting, but we're still in the world of Delta One products where, it's basically a very regulated way for regulated investors to get exposure to the asset class without holding the underlying directly, et cetera. So the pitch for ETF is clear, and we're seeing a lot of people doing just purely kind of asset allocation, diversification, and a little bit blindlessly allocating a part now of their portfolio to Delta One cryptocurrency, Bitcoin and ETH products. Something interesting that we've noticed in the trends of indices is the more thematic indices, volatility control indices. You could have some more sectorial type indices of specific tokens that are representative or of specific part of the cryptocurrency industry. And that is at the same time extremely exciting. On the other hand, very much limited by the sheer structure of the crypto markets today, as much as Bitcoin and ETH are extremely liquid, and you have, top 5, top 10 crypto assets that are very kind of decently liquid for an emerging asset class. It's still hard to build thematic indices on a larger number of cryptocurrencies. And the reason for that, and this is a lot of work we're doing on the Kaiko indices front, is about filtering out what we call an investable asset scope, just to make sure that, if you want to build an institutional product on any given cryptocurrency, you need to ensure that the strategy that you're going to create with your index is actually replicable at some level of scale if it's going to be tailored for institutional products. And I think that is probably where the industry is going to, there's a lot of exciting prospects because the asset class is fascinating and very deep, and there is a numerous now type of token types. However, it's still a matter of getting enough liquidity and trading activity and liquidity on regulated exchanges with assets that can be safeguarded by reputable custody solutions and all of that. So a lot of the work we're doing is really around exchange ranking, custody solution vetting, and creating that kind of vetted assets pool that can be used then for creating financial investment product. And that is really the first step for any kind of business in the index world of creating that asset eligibility and eligibility criteria around asset vetting.
You make some good points there. One thing that I've, which makes sense, is when there's a new ERC20 token, generally speaking, that's kind of immediately offered by kind of all the regulated custodians out there because they support Ethereum. However, when a new layer one blockchain comes on board, there's obviously like technology challenge to supporting that. So there can be significant delays before custody is enabled there. And then you talked about taxonomy. I guess it also depends on where you draw the line, right? There's taxonomies out there catering to thousands of assets. There's taxonomies catering out there to 100 assets, right? So how you break down the ecosystem is going to be drastically different, particularly with the tail end of cryptocurrencies and where there's a lack of liquidity. So I hear you there. You talked a little bit about Delta One products. Obviously, when we think about the Bitcoin ETF, that's a long only potential position that we're showing there. But, one of the challenges when we think about market structure is if some of these firms are indeed doing, say, delta neutral strategies, then where are they taking the other part of that transaction? Is it only the CME future that they're looking at? I would say that that's probably not the case. So do you maybe want to talk a little bit about where you're seeing kind of demand for that kind of derivative data, and perhaps where you're seeing venues being more popular or not with that kind of clientele?
Absolutely. And so that is really one of our core businesses, is the kind of the world of benchmarking data. You mentioned, derivatives. In order to settle any kind of financial products in a regulated fashion, you need to work with regulated market data providers that can provide data that can be settled against. And so that's part of what we do with Kaiko indices. It's our price rates and benchmarks, which is, to be blunt, a direct competitor of CF benchmarks. And in order to provide those prices, so first of all, you need to live under, as you know, Bloomberg does BMR rates all the time, but BMR stands for benchmark regulation. It's a pretty intense regulatory framework that regulates what a data provider can do when it comes to data used for the purpose of settling financial products. So Kaiko indices, which is our subsidiary that handles those topics, is regulated under BMR and issues benchmark rates for settling financial products. So there are currently a couple of providers of regulated rates in cryptocurrencies. Kaiko indices is one of them. So it's not just CF benchmarks, not do this, which is the CME underlying benchmark is CF benchmark. So that's when it comes to the settlement data. Did I misunderstand your question? Is it about where do we find liquidity for hedging Delta One products? Is that what you meant, or did I?
No, when we talked about the delta neutral kind of strategies, right? Like one part of that is going long in the asset itself. So we could consider that maybe the Bitcoin ETF. The other part of that is potentially going short in some sort of like future or derivative. So the CME is one option, but of course, probably not one that's the most popular with all kind of crypto participants. So, if you're kind of looking at these venues and aggregating trading data, from your client base, institutional client base, where are you seeing the kind of other part of that potential delta neutral trade happening, or do you have any commentary on that?
So on the more exotic side of investment products, the majority of options are still traded on derived, which is the largest centralized cryptocurrency exchange for options. And then there's a lot of OTC happening, which is not on trading venues, for which we would directly provide volume data and trading data. But options market, clearly a lot happens on derivatives. Then you have a couple of smaller exchanges still, providing liquidity on like OKX and a couple of other trading venues. And we're starting to see a lot of the more mainstream, like Gemini, started to offer their perps and derivatives offering, bullish as well. So you're starting to see more, traditional spot exchanges launching their options exchanges. So hopefully the amount of venues and availability of products is going to be much it's not going to be either CME or derivative. I think you're going to have a flurry of option and trading venues providing derivatives and perps.
Cool. So I think it's kind of impossible to talk about navigating crypto markets, but also without kind of talking a little bit about, I would say, the tokenization efforts that are currently happening, and how in the future, with tokenization becoming a larger theme, how market data is going to play an important role in that. So from a Bloomberg perspective, we are a big fixed income house. So of course, the tokenization of fixed income has been a theme that we've been, closely following. And, any Bloomberg terminal users can jump onto the Bloomberg terminal and see the cohort of digital bonds, how we describe them, how they compare to peers within the digital bond space, or how they compare to, similar bonds that are not necessarily digital. And look, we do this all the time. We would do this for green debt when that came out, and sustainable debt, and all the different derivations of bonds that are there. When we've kind of done this analysis and look to cater to this market, one area that we've been quite surprised in is, yes, digital bond issued, token out there, sold to investor in a wallet, and then that's kind of the end of it, right? What we were hoping for, and I think what we're looking towards the space to provide is a more efficient way to collect fixed income data. It would be ideal to be able to jump into the blockchain that's issued that bond and be able to take out the reference data of that fixed income instrument to then be able to provide that to our clients in an efficient way. But as tokenization continues, there's going to be a need for, of course, we want data to come out into our area, but there's also going to be a need for data from our kind of traditional market space to start to come back in to the tokenization area for potential use cases in the future. So I know that you're thinking about this. Where are you thinking about this in terms of what asset classes, and how are you thinking about solving some of the data challenges in that space?
Yeah, absolutely. So I think tokenization is probably, and by tokenization I mean blockchain-based tokenization of traditional assets and securities is going to be one of the major kind of next wave of financial engineering. I think it's the biggest opportunity that the capital markets industry has to rethink from an operational and infrastructure standpoint how we do things. Today, there's been a lot of initiatives about tokenizing bonds. The latest one where BlackRock, I like that they did kind of the two sides of the spectrum. They did, let's put Bitcoin in ETFs, but let's also put bonds in a token, and let's put that on a public blockchain, which I think is great. Today, tokenized securities are still more of a kind of extra layer of technology on top of the traditional financial instruments. I think for us data providers, it's going to be extremely interesting once we start seeing tokenized assets have a on-chain liquidity, as in an organic market on-chain. It could be a permission market, it could be on a public blockchain, a market in which specific type of investors that are authorized to participate would participate. I'm not saying we should tokenize T-bills and put them on DEXs right away. But I do think that once we're starting to see on-chain trading activity related to those tokenized securities, this is the moment where we're going to start seeing operational efficiencies tied to the fact that this underlying is now held in a tokenized form versus a traditional form, and then with a layer of tokenization. So I think this is an incredible opportunity. I don't have the number on top of my head, but I think we're talking almost $1 trillion or something of tokenized assets already. So I'm really looking forward to the first steps of having on-chain liquidity. But that, you mentioned it, means standardizing a lot of things and being able to put in a blockchainized form a lot of the referential data that is necessary for the existence of traditional financial assets. And this can be type of calendar days. There's so many standards and so much data taxonomy to be done in order to have on-chain activity that can deliver, settle, and kind of trade in a decentralized fashion. Kaiko, we're taking part in a lot of working group around standardization, taxonomy, data management, and how do we onboard some more traditional market data kind of back-end infrastructure into blockchain and incorporate that into the tokenized products. So I think these are a lot of the big pillars that are being worked on right now. And that it's going to be extremely exciting when we see market data that is generated on chain. That's one part. The second part is if we tokenize not just the assets, but the contracts, and let's say an equity derivative contract can be represented by a smart contract. It's very possible that the underlying that is referenced by the smart contract actually doesn't have a price or a market data on chain, but that you would need a provider like Bloomberg to provide the actual price of the underlying. A company like us, Kaiko, could serve as the data infrastructure provider that writes to the smart contract, provides the price as it was created by Bloomberg, provides that price to the smart contract in order to trigger the execution of the smart contract then in an entirely disintermediated fashion on chain. So I think the role of data provider, who is already critical in the current capital markets industry, is going to be incredibly critical in the future, because it's going to be the catalyst to the execution of on-chain contracts, which is one part. And the second part is we are going to have we will need market data providers that can speak to blockchains from an infrastructure standpoint, that can read data generated on chain, and that bridge from a technical standpoint between blockchains and traditional financial market data system is, I think, a critical part in scaling that next wave of innovation.
Yeah, you mentioned a couple of things there, and one that resonates strongly is kind of I guess identifiers and taxonomy of kind of tokenized instruments. When we've kind of looked at what's been happening in the experimentation out there, of course, there's a wide gamut of experimentation. There's experimentation with private blockchains, there's experimentation on public blockchains, there's experimentation with different mediums of settlement. Some of these are settled off-chain in traditional fiat. Some of them are settled with experimental stablecoins from the Bank of France in the case of some EIB, not stablecoins, CBDC, sorry, from the Central Bank of France in the case of a recent EIB bond from Goldman. So, from our perspective, it's really important to get kind of like an industry agreement across what kind of additional metadata is required, because as things transition, there's going to be HQLA portfolios in banks that are going to have high quality liquid assets that may be tokenized, and there could be different risk profiles for that of a bond on a private blockchain than that of a bond on a public blockchain. So kind of what data is really required by customers in the future to kind of categorize these is a little bit of an unknown, which is kind of interesting. Because it's always nice to kind of work on big new problems, but one that's really, really, really needed to be able to solve for some of these challenges in the future. So
Absolutely.
I completely agree with you there. So look, I've just seen the 1 minute warning, so I think we should be wrapping up. But look, thank you very much for your time. It was a pleasure to discuss some of the insights and challenges in crypto market data, and always a pleasure.
Thanks a lot, Alex. Great to see you.